Hello, I hope everybody's semester is starting out well. This is the first official lecture of Accounting 1. Now, everybody should have had a previous session where we talked about class policies. For you face-to-facers, we did that last time. We didn't film that. And for you people at home, I did a separate filming and taping of going through the class policies for you. So please make sure, those folks at home that are taking this as an online class, that you watch that. Don't just skip it thinking it's not going to be important. It's very important to succeed in this class. I want you to know how we're going to do things. So for the people watching at home on YouTube or on DVDs or on the cable TV channel, never skip the lectures, okay? Watch them in sequence, watch the whole thing. If you try to shortcut it, you'll do yourself harm. So at this point, everybody knows the class policies and procedures and everything, and we're going to go ahead and start the subject of accounting. Now, I always like to say at the very beginning, some people have to take this class, and it's like, oh, I wish I didn't have to take this, but I have to. It's required. Some people want to take it. Truth be told, out of the 15 of you here, there's maybe only one or two that might be a full-time accountant someday. So sometimes the question comes up, why do we have to take accounting? And I'll tell you. Several reasons, but one of them is, statistically speaking, about half of you are going to own or co-own a business sometime in your life. Now, it may not be your sole source of making money, but it may be just an ancillary income. But you will own or co-own a business. And I've talked to some of you, and a lot of my students, they want to be entrepreneurs. They want to own a business someday. Well, if you do that, you need to know accounting, at least at some level. And you might say, well, I'll just hire somebody to do my accounting. But what's the problem with that? Anybody know?
Cost money.
Cost money. And what's the other one? You might get ripped off. Okay? You can look at the business section and see what happens when a business owner gives all of their accounting responsibilities to somebody else. And it's like, well, we trust that person. I could tell you horror story after horror story from my days as a financial statement auditor of small businesses that somebody ripped them off because that person didn't know accounting at all. Okay? So maybe you won't do all the bookkeeping, but you at least at some level need to know accounting. Accounting is the language of business. Plus, wherever you all end up working, there's going to be a bottom line. There's going to be a net income that you need to meet, right? I mean, JCCC is a not-for-profit, but we concentrate on that bottom line too. We have to stay afloat, don't we? In your own homes, you have financial situations, right? So the language of business is accounting, and it's very important to know. So I know there's a lot of reasons for being in this class, but I want you to remember that those basic concepts of business and how important it is to apply to accounting. Now, the first thing I want to do is I go over, and you should have the PowerPoint slides. For you folks here in face-to-face, I handed these out to you, okay? And for you folks at home, I have these on Angel under the Lessons tab, okay? I think it's very beneficial to have these so that you don't have to copy everything down that's on the screen, and you can just take notes to the side or however you'd like to do it, okay? So let's go ahead and go through the very first slide for Chapter 1, and that is going to be kind of the definition of accounting. Now, I spend a lot of time on this slide, so don't think that every slide we do we'll spend this much time on, but I think this is a really nice definition. And I'm not the type of teacher who is going to give you a test question that says, write out the definition of accounting. Because truth be told, you could find another textbook and it probably would be slightly different. But this one has a lot of good aspects to it, and I want to concentrate on that a little bit. It says accounting is a system that identifies, records, and communicates information that is relevant, reliable, and comparable to help users make better decisions. Okay, let's go off the PowerPoint and come back. And I want to step away from that for a second and take you to a different example that I think will help flesh out that definition. Okay? Let me write something down here that has absolutely nothing to do with accounting. And tell me if anybody knows what I'm doing. I'll give you a clue. It has to do with sports. I'm sure you're all going, what is he doing? Right? You have any idea what that is? Anybody want to make a guess? It has to do with basketball. Okay? Anybody here play basketball? Okay? You've watched basketball, right? Okay? You know what a free throw is, right? It's when the player gets fouled and they go to the line and they shoot free throws, right? Well, one of the things I did in high school, I love basketball, still do. I couldn't make the basketball team at my high school. So what I did, and this sounds like a geeky future accounting professor sort of thing to do, I kept stats for the basketball team, traveled around with them and kept stats. Okay? So let's go back to this. Do you see how this applies to free throws? What this meant is player 12 got fouled and he went to the line for 2 free throws. He missed the first one, so I didn't color in that bubble, and he made the second one, so I colored that in. You with me? Okay, then player 17 got fouled for 2 shots. He made both of them, so I colored in the bubbles. Number 9 player got fouled. What does that look? That looks a little different, doesn't it? Anybody want to venture to guess what that is? Not a technical. Do you know what a 1-and-1 is? Certain types, if you get fouled, you don't get 2 free throws, but if you make the first one, you get a second attempt. Does that make sense? So I would draw that. It kind of look like a little cherry, right? So this guy got fouled. He made the first one, so he got a second attempt, right? If he wouldn't have made the first one, it would have just looked like that. Okay? This one, there's just one bubble. What does that mean? Anybody want to guess?
He got fouled but made his shot.
He made the shot, but he got a free throw. So if you get fouled while you're making the shot, you make the basket, you get 1 free throw. Now, why do I show you this? Because this has nothing to do with accounting. Well, this is one of the things as a basketball statistician that I kept track of for the coaches. Now, the next day when I would come to school, do you think the coach wanted me to hand them this report with the bubbles? Go back to the screen. Do you think that this is what they wanted? What did they want?
A condensed version.
They wanted a condensed report. And I made up just a sample report. Okay? This is kind of what they wanted. This is a free throw report for Northwest versus Southeast on October the 20th of 2011. This is the player, Jones. This is the free throws attempted, 8, and he made free throws made, 4. So he shot 50%. Smith went to the line and attempted 10 free throws, only made 8, shot 80%. Do you see what I'm saying? This was the report I gave the coach. Now, why would the coach care about having this information? To know who the best free throw shooters are. Maybe there's a technical during the game, and who would you want to put to the line? Probably whoever your best free throw shooter is, right? You'd want to know who needs to work on free throws, who's getting better, who's getting worse, right? But do you agree that if you were a basketball coach, a report like this would help you make better decisions? Is that correct? Okay, good. Now let's go back to the PowerPoint now, that definition. And let's apply this to the basketball example I just gave. That was a system that identified, recorded, and communicated, wasn't it? For instance, I would hear the whistle blow, and it would identify that I need to record something, correct? It identified that somebody was going to go to the line, and I needed to record it with that little bubble method. And there's nothing magical about that bubble method. I didn't make it up. It's a common way to keep track of free throws. Eventually, I would communicate that to my coach, right? Now, I would communicate it so it would help him make better decisions, correct? However, for it to be able to help him make a better decision, it had to be relevant, reliable, and comparable. What does that mean? Let's talk about that. What does it mean to be relevant? Well, to be relevant, it means it needs to be in regards to the game that he's concerned about, right? What if I would have given him the free throw statistics for the 1972 Olympic game between Russia and USA? Is that relevant? Is that going to help him make a better decision? No. Okay, so it has to be relevant. It has to be related to what he's concerned about. It has to be reliable. Has to be reliable. What if I don't know what I'm doing as a statistician? Is it going to help him make better decisions? No. What if I told him, hey, coach, here's your report from last night, but I'm going to be honest with you. I was pretty drunk when I did it. There's a lot of mistakes. I fell asleep during the third quarter. Don't know how reliable it is. Is it going to help him at all? No. And I did not drink as a high school student. Okay, so note that if my mom's watching. Okay? The third one, it has to be comparable. What does that mean? What that means is there has to be a consistent method that we are using to keep track of this stuff. There has to be rules. Okay? For instance, we always count a free throw made as if it goes through the hoop, right? What if I said, well, I changed the rules. I started to count it as a free throw made if it even just hit the rim, even if it didn't go through. Well, I've changed the rules. Is that the way we've been doing it? No. Okay, so it's no longer comparable to previous games. Is it going to help him make a better decision? No. So go back to that one more time. This was a system that identified, recorded, and communicated. And if it was relevant, reliable, and comparable, it would help him make better decisions. Accounting is the same way. Now let's stay on this for a second. We identify things that need to be recorded. These will be transactions that need to be recorded, such as buying office supplies, or selling services to a customer, or paying our employees, or getting a loan from a bank. We record that information, and eventually we're going to communicate it through a report, through a summation, like you were saying. And if that information is relevant, and if it is reliable, and if it is comparable, we're following the rules, it will help our users make better decisions. What sort of decisions would you see in the business world that would be aided by having financial information presented to them in a report? Maybe, do I want to invest in this company? Maybe do I want to extend credit or make a loan to this company? How's the business doing? Are we going to have enough cash to pay salaries next month? Right? If you have a business, you want to have accurate financial information and financial reports. That's what accounting is about. Okay? So does that flesh that out a little bit for you? Okay? Let's move on a little bit. And I like to have our lectures be a mixture of me talking and then maybe taking a break and doing some exercises and then going over those. I don't like it to just be me talking, but like I always have to say, this first lecture is a lot of me just talking because we haven't really done anything yet, right? So please don't be concerned if you're going, geez, are we just going to have to listen to this guy for 50 minutes every time? No, we'll be doing stuff. That's why I want you to bring your textbooks, bring your calculators to class. There'll be a lot of times where we take breaks and you'll work on it for a while. But this lecture is kind of me jumping around and giving a lot of basic business concepts so we can start to build our foundation. Okay? Cool. All right, let's go on. There are two sets of users of accounting information. There are external users and there are internal users. External users are those that do not work at the company. Okay? They work outside of the company, such as lenders or banks or credit unions or shareholders or stockholders or potential shareholders and stockholders, the government, consumer groups, customers, external auditors. Do you know what an audit is? An audit is when you go in and you look at the records of a company and you verify it. Sometimes people think of an IRS audit, right? But all of those individuals, they are external to the company, correct? They don't work there. They're outside the company. Now, external users, financial accounting is the accounting that serves external users primarily, and that's this class. Now, there are also internal users. These are the people that work at the company, such as managers or the sales staff, or the internal auditors. Some companies are so big, for instance, Sprint, they have their own internal audit department. They're within the company. They're internal. There's also the controller. Do you know what a controller is? The controller is the chief accounting individual. He or she is in charge of all the accounting. They call it the accounting controller. But all of those individuals are internal to the company. You with me? Now, the type of accounting that is mainly concerned with internal users is managerial accounting. Have you heard of managerial accounting? Does anybody already know that eventually they're going to have to take managerial accounting? Yeah. A lot of people will take financial accounting, which is mainly concerned with the external users, and then eventually they take managerial accounting, which is the internal users. Okay? All right. Let's go to the next slide. Just like there are rules of basketball that must be followed, there are rules of accounting that must be followed. And this will help ensure that the information remains relevant, reliable, and comparable. Okay? And we know it has to be those three things for it to be useful. So there are what's called generally accepted accounting principles, and sometimes we abbreviate that GAAP, GAAP. These are the rules that have been put into place that we have to follow for accounting. Okay, and we'll start learning some of those. Now, who sets those rules? Those are set by somebody called the Financial Accounting Standards Board, and we abbreviate that sometimes the FASB. This is the private group that sets the rules of accounting. Now, they take input from a lot of different groups, such as the SEC, the Securities and Exchange Commission. Have you heard of that group? They're the government body that has the reporting rules for companies that trade stock, that issue stock to the public. Okay? They certainly have input to the FASB on what GAAP is. There's also something called the International Accounting Standards Board. And they deal with international standards. Okay? So they certainly have input to the FASB as well. Now, one thing about international standards is we're becoming a much smaller world in some ways, aren't we? Right? Any of you, have any of you going to the classes, have any of you ever Skyped? Do you know what Skyping is? Have you ever Skyped with somebody overseas? Okay? Okay. Have you ever purchased something over the internet overseas, from overseas? Okay? Now, if I would have asked this in accounting class 20 years ago, first of all, you'd say, what is Skype? Okay? Secondly, you wouldn't think about buying something from somebody in Germany, for example, because it's just not possible. But with technology, with communications, we're becoming a smaller world, aren't we? Okay? It's always interesting with these accounting lectures being on YouTube. I'll get emails. I've gotten emails from people in Poland, Saudi Arabia, London, all over the world, that somehow they stumble upon these lectures, and for some reason they watch them. Maybe they're taking an accounting class and it kind of helps them. But it's kind of fun to hear from those. If somebody out there is watching it, shoot me an email. I'd love to hear from those people. But it's a small world, isn't it? Well, because of that, we have to start having some international standards, because companies are becoming global with operations not in just the United States, but other countries as well. So you might have hear of something called IFRS. That stands for International Financial Reporting Standards. And they identified the preferred accounting for companies. Okay? And we won't get too much in this, but I want you to be aware of it. That IFRS is more and more concerned each year with how are we going to make the accounting operations in London comparable with the ones in Georgia. Okay? How are we going to do that? We want to try to find a common set of rules. And that's what IFRS is. Okay, now I want you to read about now we're switching to a different subject, and I want you to read about this in your books, the business entity forms. And this is on page 11 and 12 of your textbook. Now, I'm not going to go through every aspect of this, but I want to hit on some high points. It's on page 11 and 12 in your textbook. And what I want to do is, and I'm going to double check that, make sure I gave you the right pages. Yes, I did. Okay. 11 and 12 in your textbook. Now, if you start a business, one of the first things that you have to decide is, how do I want to set up my business? And there's three main ways you can set up that business. You can set it up as a sole proprietorship, as a partnership, or as a corporation. Okay, those are the three main ways. Now, there's kind of different subways under each one of those, but for the purposes of this class, we're going to kind of concentrate just on those three ways. Now, there's a nice chart in your book. I'm not going to talk about every little row and column on here, but I want you to read about this and to know this. Let's highlight a few of those. Okay? Proprietorship versus a partnership versus a corporation. Okay? Now, let's come off the slides for a second. And it's Jake, right? Yes. Let's say you started a landscaping business, Jake. You could set it up as a sole proprietorship where you are the only owner and you don't incorporate or anything. You are just a sole proprietorship, right? Or what you could do is, let's say there were two owners, and it's Jake and Matt. Let's say there were going to be two owners, and you're not going to incorporate, but you're going to be a partnership. You could set it up that way. Or the other thing that you could do is incorporate. Now, going back to the previous slide, looking at it real quick, you might think sole proprietorship means one owner, partnership means just a few, and corporation means a lot of owners. That slide kind of indicates that, but that's not totally true. Because going back to you, Jake, even if you were the only owner, you could incorporate. What it means to incorporate is you set your business up as a separate legal entity. A separate legal entity if you're a corporation. Huh? Not so much a contractor, but like Sprint is a separate legal entity. But even your landscaping business, you could be a separate legal entity and set that up completely separate from you as a human, you as a person. As a matter of fact, if you incorporate and you die, the corporation is still alive, right? Or if you're a partnership, you could incorporate. So I don't want you to think corporation always means hundreds and hundreds of owners, because there's actually a lot of corporations that are just one or two owners. A corporation means you have gone through the paperwork and fees and procedures to set it up as a separate legal entity. Does that make sense? Okay, going back to this slide. No matter how you set up your business, you are going to be a separate business entity, which means you're going to keep your business books separate from your personal books. You don't want to commingle those records. Okay? Jake, you don't want to keep track of your landscaping business in the same checkbook and records as you do your personal life. Or if you have more than one business, you want to keep those separate as far as record keeping. But only a corporation is a separate legal entity. Okay? Now, the nice thing about a corporation is a corporation has what is called limited liability. A proprietorship and a partnership have unlimited liability. Unlimited liability is a bummer. It's a bad thing. For example, let's say, Jake, that you have a landscaping business and you are set up as a sole proprietorship. And let's say that you have a lawn mowing incident and you run over somebody and they die. Tragic lawn mowing incident. Well, since you have unlimited liability as a proprietorship, they could come and sue you and take your personal assets, your home, your savings that grandma left you, all that sort of stuff. If you're a partnership, and you're not incorporated, you're a partnership, and let's say Jake has a tragic lawn mowing incident, right? Well, let's say Jake didn't have any money, but Matt's loaded. They could actually come and take your assets. You have unlimited liability. That's a bummer, isn't it?
Yeah, I don't want it.
Yeah, he did it, and they're taking my assets, right? Ugh. Unlimited liability is a bummer. You want to have limited liability. That's why you might incorporate. What that would mean is this, is if you incorporate and that situation happens, they can come try to take the assets of the business, but they can't take your personal assets. It's kind of a shield. Sometimes we call that a corporate shield. Does that make sense? And that's why one person might incorporate or two people might incorporate. Okay? So unlimited liability, bad thing. Limited liability, good thing. Okay?
What's the processes of getting either or?
The process of getting to be a corporation?
No. Like limited or unlimited liability. Like,
Well,
do you
to
make
be in this framework, if you want limited liability, you have to incorporate in some way, which means that there's certain policies you have to follow, paperwork you have to fill out, fees you have to pay to the government, maybe records you have to provide to the government. Sole proprietorship is easy. You really don't have to do much. You know, you just be a sole proprietorship. Okay. Okay, unlimited life. A proprietorship, a partnership, they have a limited life. That means if you die, the business is over. But a corporation has an unlimited life. Okay? If you are an owner or a shareholder of Sprint, for example, you think about that. You own part of Sprint. If you die, is Sprint going to keep going on? Yeah. They probably won't even send you a card or flowers or anything, will they? Okay? They keep going. A corporation has an unlimited life. Is the business taxed? Well, that's the bummer about being a corporation. The great thing about being a corporation is it has limited liability. The bummer is a corporation is taxed. Now, let's explain this real quick. Let's say you are a sole proprietorship. Sole proprietorship. Does that mean you get to enjoy a tax-free life? No. That just means that you fill out an informational tax return and you pay your taxes at the personal level. Same thing with a partnership. The partnership is not taxed. But a corporation is taxed. And let me explain that in real elementary terms. Sprint has a pile of money, then they have to pay taxes, and that pile of money is now less, right? Then they pay dividends to their owners or their shareholders. Do the individual shareholders and owners have to pay taxes again on those dividends? Yes, they do. That's called double taxation. That's a bummer, isn't it? Doesn't seem fair, does it? Corporation pays taxes, and then they distribute the money to the owners, and the owners have to pay taxes again. That's the big bummer about being a corporation. You with me?
Proprietorships, do they have to pay like payroll taxes? No,
Yes.
they do.
Yeah, that's a great comment. I'm not talking about payroll taxes or sales tax. I'm talking about income tax. Okay? Good question. Is one owner allowed? Like I said, yes, you can have a one-owner corporation. Proprietorship is just one owner. If you're a partnership, you can't have one owner. You have to have two or more. Now, there is something called a limited liability corporation, an LLC. Have you ever heard of that? That's a great way to start a business because, let's say the two of you started as an LLC. You would have the advantages of having limited liability, that's good, and you also would not pay taxes at the business level, only at the personal level. The question might be, why doesn't everybody be an LLC? Why doesn't Sprint be an LLC? Sprint would love to be an LLC, but there are rules that you can only be of such a certain size or less to be an LLC. Once you have more than a certain amount of owners, you have to incorporate, basically. Okay? Does that make sense? But if you were going to start a business, I would bet you that your lawyer would advise it to be an LLC. Okay? But you'd have to talk to him or her, right? I had a business and I was an LLC because I wanted the limited liability and I did not want to pay taxes at the business level. Cool? All right, we're going to talk about a few more things that's really important. This is your new buddy, the accounting equation. The accounting equation. What is the accounting equation? The accounting equation is assets equals liabilities plus owner's equity. Okay? Now, I want you to remember something here. Come off the slides real quick. When you first learn something, you're going to have somebody like me who's going to teach you something, and you have to trust me a little bit, right? Like when I taught my son to play baseball when he was just a real little kid, I told him how you hold a baseball bat, right? Now, he doesn't know. He's just got to trust me that that's the way you hold a baseball bat. If I wanted to be mean, I could show him some weird way, and he wouldn't know, would he? No, I'm not going to do that to you, okay? There are some things I'm going to teach you in Chapter 1 and throughout this whole course that you're not going to understand the full implications of it, but I want you to memorize it, okay? You with me? Trust me. And the implications will come into play as the semester progresses. But going back to the accounting equation, for now I want you to memorize that the accounting equation is assets equals liabilities plus equity. Are you with me? Cool. Okay, now let's flesh that out a little bit. What are assets? We've heard the term assets. These are the resources you own or control, aren't they? Okay, such as cash. That's an asset. That's a resource. If you have vehicles or supplies or land or equipment or buildings, supplies, those are assets, right? Those are assets that you own. A couple of these require a little more explanation, such as accounts receivable. Jake, let's go back to your business. Let's say you mow my lawn and you charge $50 for a lawn mowing, and I just say I'm going to pay you later. I'll pay you next week, okay? And you say, that's fine, I trust you. You would have an account receivable from me, the customer, because you're going to receive cash in the future. Does that make sense? That's an account receivable on your books, okay? Anybody here work at a bank by chance? No? Okay. Well, I have a car loan with Bank of America. They have a note receivable from Dave Krug. A note is similar to an accounts receivable, but a note is a little bit more formal. It's usually written down, hence note receivable, and there's usually interest involved. But an accounts receivable or notes receivable is an asset. You're going to receive cash in the future. Does that make sense?
Is a notes receivable dated?
It's usually dated. I mean, have you ever had a loan, student loan, car loan?
No.
Good for you. Keep living that way. Okay, when I did my car loan, though, for those of you who have car loans or student loans, did you have to sign and date a bunch of stuff? Did they say an interest rate? It was more formal than when you just say, hey, you can just pay me next week. You see what I'm saying? Mm-hmm. We're not signing anything. There's no interest. That's an account receivable. With a bank, it's a note receivable. Good question. All right. What about liabilities? Well, unfortunately, most of us know about liabilities. This is debt, isn't it? These are things that we have to pay in the future. Okay, going back to Jake, you have an account receivable for $50 on your books from me. Well, on my books, I have an account payable to you, right? That's a liability on my books. Bank of America has a note receivable from Dave Krug for the car loan. I have a note payable to Bank of America, right? Okay. There's also things like taxes payable. Going back to the slide. Taxes payable are taxes that I owe that I'm going to have to pay out cash for. Wages payable or salaries payable. Anything ending in payable is I owe this person or this company or whatever, and I'm going to have to pay them in the future. That's debt, right? Some of you have student loans payable. Anybody here own a house? I do. Okay, you have a mortgage payable, right? So those are liabilities. Okay? Now let's talk about equity. What is equity? Now most people understand what assets are, generally speaking. Most people understand what liabilities are, generally speaking. But then they get to this equity thing and they go, oh, what's equity? And we've heard about it before, but it's hard to get your arms around what equity is. I think the best way to learn about what equity is to talk about how equity increases and equity decreases. But this is the owner's investment in the company. So I want you to know this. As a matter of fact, for you face-to-facers, we are going to have a quiz at the very beginning of next period. And it's going to be right at 9 o'clock. So if you're late, you'll miss it. But the quiz is going to be, number one, what is the accounting equation? And that is assets equals liabilities plus owner's equity. The next question I'm going to ask you is, how does owner's equity increase? And then the final question will be, how does owner's equity decrease? So you folks at home, even though you cannot take this quiz, I want you to act like it's a quiz. Because I have found, through teaching this class many times, that this is a fundamental principle that I want to get in people's heads and will make everything easier. Okay? So know the accounting equation. Don't just abbreviate either. Assets equals liabilities plus owner's equity. And now let's talk about how owner's equity changes. How does owner's equity increase? Well, there's two ways. The first way is investment of assets by the owner into the business. Investment of assets by the owner into the business. Going back to Jake and your business. Let's say that grandma died and left you $10,000 in her will. She gave it to you personally. And you decide to take that $10,000 and start your business with it. Well, you are investing personal assets into the business. That increases your owner's equity. You with me? Let's say that you own a truck and you decide to put it into the business. That's putting a different type of asset into the business. And that increases owner's equity. You with me? Okay? So putting assets into the business increases owner's equity. The second thing that increases owner's equity is revenue. What is revenue? We kind of know what revenue is, right? When you said you were going to mow my lawn and I'm going to give you $50 later, that $50 is revenue. And you don't even really have to wait until I pay you. That's revenue as soon as you're done mowing the lawn, and we'll talk about that here in another lecture. If you go buy a $20 DVD at Best Buy after class today, that's $20 of revenue for Best Buy. If you pay $15 to get your hair cut, that's $15 of revenue to the barber, correct? Right?
Taxes aren't included.
Yeah, we're going to kind of ignore taxes for now because the taxes really aren't. That's something you have to give the government. But ignoring taxes, if you pay $15 for a haircut, that's $15 of revenue for the barber. Right? Make sense? You go buy a $5 meal at McDonald's, that's $5 of revenue for McDonald's. So these are the two things that cause owner's equity to increase. Investments of assets by the owner into the business and revenue. Now I'm telling you right now, face-to-facers, this is the quiz. This is the question. These are the answers. Sometimes people will give me answers that sound right, but they're not. Such as they'll say cash. Well, no, cash doesn't always cause owner's equity to increase. If I go get a $50,000 loan, I have cash, but does that cause owner's equity to increase? No. The answers, the question and the answers to the quiz are on this slide right here. The two things that cause owner's equity to increase are investments of assets by the owner into the business and revenue. Okay? It's just that simple. I know you don't understand the full implications of this, but trust me and just memorize this for now. Now let's talk about the two things that cause owner's equity to decrease. And this is going to be the flip side of what we just discussed. If putting assets into the business increases equity, taking assets by the owner out of the business decreases equity. That makes sense, doesn't it? Why might you take assets out of the business, Jake? Well, let's say you need some money to pay your apartment rent or to buy groceries. That's why you have a business, right? So you can take money every now and then and support yourself. Well, that's fine. That's expected. But when you take those assets out of the business, that decreases your owner's equity. Make sense? That's expected. That's normal. Assets in increases, assets out decreases. Marlon.
How would that work for like a corporation, like somebody taking the assets out?
What that would be is how would assets leave a corporation and go to the owners? Through dividends primarily. Okay? So it's a little different when you think of Jake's landscaping business versus Sprint, but the principles still basically apply. It's just a little different. Good question. Okay? All right. Now, if revenues caused owner's equity to increase, what do you think causes owner's equity to decrease? Expenses. You're exactly right. You have salaries expense. You have advertising expense. You have gasoline expense. Expenses cause owner's equity to decrease. So I told you what's on the quiz, didn't I? Yes.
So would like buying a chair for your, let's say, salon, would that be an expense, but once it's in your salon, it would be a revenue?
No. Great question. And there's a lot of different concepts wrapped up in that question. And it's a great question. I'm not going to be able to fully answer it today because it's going to involve some principles I'll talk about in the next couple lectures. First of all, if you buy a huge asset, we don't expense it. It's an asset. And that's not an expense. Now we'll depreciate it over time. We'll expense it slowly, and that's when it causes owner's equity to decrease. Okay? And then there was a second part of that question. I forgot it already. Oh, does it become revenue? No. No. Revenue is when you provide products or services to customers and you receive and you can book that as revenue and you'll eventually receive payment. Okay? The chair is never going to pay you for anything. It's not a customer. Does that make sense? Mm-hmm. Great questions. So there's the whole quiz. What's the accounting equation? Assets equals liabilities plus owner's equity. What causes owner's equity to increase? Going back to that slide, investments of assets by the owner into the business and revenue. What causes owner's equity to decrease? Withdrawals of assets by the owner out of the business and expenses.
Would revenue still be a positive thing for equity if it was a non-profit company?
Yes. Now, I want you, and it's a great question. You're asking about not-for-profits. And you asked about a corporation, Marlon. These are excellent questions. However, I'm not going to fully be able to answer them. Okay? It's kind of like baseball. It's like if I was teaching my son how to play baseball, and I would teach him, when you're on first base and they hit the ball, you run, right? If he's 4 or 5 years old, I'm just trying to get the concept that you run this way around the bases, right? Run from first base to second base. Not first to third, not first to mom in the stands, but from first to second, right? Now, for those of us who know baseball, you know that there's a lot of other implications, right? On a fly ball, you go halfway, right? There's a lot of different things. But I'm not going to try to teach my 4 or 5-year-old all those implications yet. Corporations, not-for-profits, they use these same principles, but in a slightly different way. I don't want to go down that road yet or it kind of confuses. As a matter of fact, the majority of our class, financial accounting, that you take this semester is going to be in regards to a sole proprietorship. A sole proprietorship. We'll talk a little bit about corporations. We'll talk a little bit about not-for-profits. Trust me, these concepts apply, but it's a little different, okay? So I think it'll be easier to try to think of Jake and his landscaping business as you learn these fundamental principles. Excellent questions. Make sense? Walk before we run, correct? Okay, what I want to do right now is we have a few minutes, and I want to do in your book, and I'll do this often, is we'll work on something in class for a few minutes, and then we'll go over the answers. For you folks at home, they're going to play this snazzy, jazzy JCCC music, and I want you to do these problems as well, and then we'll come back and go over the answers, okay? And if it takes you more time, folks at home, just pause it and play when we go over the answers whenever you're ready. But what I want to do is go over Quick Study 1-3 in your books. That's on page 31. Quick Study 1-3 and Exercise 1-3. Okay? Let's just do those right now. Quick Study 1-3 on page 31 and Exercise 1-3 on the bottom of page 32. I'll give you some time to do that. For you folks here, you can work together if you want. You can share your answers. But I'll give you about 4 minutes, and then we'll go through the answers. All right? So let's do that right now. Okay, I wanted to give you a little bit more time, face-to-facers, but we're running out of time here. So if you at home are not done, just pause it, start it when you are done. But let's go through these answers real quick. Now, first of all, notice in your textbook there are quick studies, there are exercises, and then further on there's problems. So when I give you homework, if I say to do quick study 1.2, don't do exercise 1.2, don't do problem 1.2, do quick study. So you can't just concentrate on the numbers. You have to know if it's a quick study, an exercise, or a problem. Okay? Quick study 1.3 on the top of page 31. External or internal? A lender is what? External. What about the controller? Internal. Shareholders are external. The sales staff is internal. The FBI and the IRS are external. And so are consumer groups. Consumer groups are external. Brokers, like stockbrokers, external. Suppliers are external. Customers are external. The managers of a business, internal. Business press, like the Kansas City Star or the Kansas City Business Journal, are external. And the district attorney is external. Right? Okay. Any questions there? All right. Let's jump over real quick and go over to exercise 1.3. What type of accounting is most involved? Okay. Review of reports for SEC compliance is mainly financial accounting because it's for external users who might be considering investing in the company or something like that. So number 1 is B, financial accounting, on exercise 1.3 on the bottom of page 32. Planning transactions to minimize taxes would be tax accounting. Okay, we didn't talk about that, but there's tax accounting as well. So number 2 is tax accounting. Number 3, investigating violations of tax laws, is also tax accounting. C. Preparing external financial statements. What's that? B, financial accounting. What about budgeting? That's more of an internal thing, right? So that would be managerial accounting. Number 5 is A. Okay? Number 6, cost accounting. That's more of an internal situation as well. That's also internal. That's also managerial accounting. So 6 is A. Number 7, external auditing, is financial accounting, like we discussed earlier. So number 7 is B. Number 8 is internal auditing. That is managerial accounting. Number 8 is A. Any questions on that? Okay, I know we went through that a little quick. Sorry about that. Last thing I'm going to do is give you your homework. Please do this for next period. Okay? You who've taken accounting know that the way you learn this stuff is by doing it. So the only homework I'm giving you, and once again, keep track of this, if this is a quick study or an exercise. And eventually we'll even have problems. But I want you to do quick study 1.8, quick study 1.7, and exercise 1.7. I know that this was a little bit of a longer lecture, but I wanted to get some stuff in. So thanks a lot, and we will see you next time. Bye-bye.